Okay, so 14.3, chapter 14 is about performance measurement, right? So how can we measure the company's performance, right? We will be presented with the financial information from different company, how we can make sense of the information, how we can evaluate the performance of the different companies, okay? So here, the learning objective 14.3 is about calculate and interpret ratios that are used to analyze solvency. So what's the solvency ratios? We have learned one, total debt to total asset, right? So that's the one. That's one of them we have seen before. Something new to this lecture is the times interest earned and free cash flow. We're going to talk about it. So what is the debt to total asset ratio? Well, you use the total liability divided by total assets, okay? So the lower the better, right? You want to have a lower liability. You want your numerator to be lower. That's a lower liability. So therefore, the total debt to total asset, the lower the better. Lower means you have less debt, okay? So we have seen this one. Times interest earned. So what is this? This measures ability to meet interest payments as they come due, okay? So the bankers, they are willing to lend their money to the business because they're hoping to earn interest income. They're hoping that the company will be able to be very successful, make a lot of money to at least pay their interest expense, right? So what is the times interest earned? So basically, you want to know the income before you pay the interest expense, before you pay the income tax expense. So that income before interest and tax, we call it earnings before interest and the tax, EBIT, okay, EBIT. So that EBIT is the earnings, E, B as before, I as interest, and T as tax, okay? So the earnings before you deduct interest expense and deduct the income tax expenses, that number is the numerator divided by interest expense. That's the denominator. This number is higher the better. Higher means your income is stronger. It's easier for you to cover your interest expense. Free cash flow. Free cash flow measures cash available for paying dividend or expanding operation. Okay, so the measures how much cash available for paying dividend or expanding the operation. So you use net cash provided used by operating activity minus net capital expenditure and minus dividend paid. That is called free cash flow. Well, that cash flow is the higher the better. The higher means you have a stronger ability to pay off dividend, to pay dividend and also expand the operation. So that is the three solvency ratio. Okay, debt to total asset ratio, lower the better. Times interest earned, the higher the better. And the free cash flow, the higher the better. Okay, so does anyone have any question on this? Okay, good. Okay. Okay.